Hey everyone, welcome back to Crypto Tax Australia. I'm going to get straight into it today because this is one of the most important videos I've made on this channel. And it's time sensitive. 2 days ago on Budget Night, Treasurer Jim Chalmers announced the most significant change to Australia's capital gains tax system in over 25 years, and it directly affects every single crypto investor in this country. The 50% CGT discount, the strategy we covered in detail on this channel just recently, is being scrapped, replaced with a completely different system starting 1st July 2027. Now before you panic, there is a transitional window, there are grandfathering rules, and there are things you can do right now to protect yourself. That's what this video is about. Let's break down exactly what was announced, what it means for your crypto, and what you should be thinking about before July 2027. Okay, let's go. Let's start with exactly what the government announced, because there's been a lot of noise in the media, and I want to be precise. The budget proposes replacing the CGT discount for individuals, trusts, and partnerships with cost-based indexation for inflation, paired with a 30% minimum tax on capital gains from 1st July 2027. Let me unpack each part of that. Under the current system, if you hold a crypto asset for more than 12 months, you only pay tax on half the gain. Under the new system, instead of having your gain, your cost base gets adjusted upward for inflation, meaning you only pay tax on your real gain above inflation. This effectively represents a return to the approach used pre-1999. A 30% minimum tax rate will be introduced on capital gains from 1st July 2027, which will be imposed after the application of indexation. This means even if your marginal tax rate is low, say you're retired or in a low-income year, you'll still pay at least 30% on crypto gains from that date. The announced changes are expected to apply broadly to most investments subject to capital gains tax outside superannuation, including Australian shares, ETFs, managed funds, business assets, startup equity, employee share schemes, cryptocurrency, and other growth assets. Crypto is explicitly included. This is not just a property story. Investments held inside superannuation funds are not currently expected to be directly affected by these particular CGT changes. Super funds qualify for a 1/3 discount rather than the 50% discount, and will keep that treatment. Okay, this is where it gets really important for crypto investors, because the transitional rules determine what happens to crypto you already own. The transitional rules will operate as follows. For assets that are acquired and disposed of prior to 1st July 2027, the CGT discount will continue to apply where the taxpayer is eligible. So if you buy and sell crypto before July 2027, nothing changes. Old rules apply in full. For assets acquired prior to 1st July 2027 but disposed of on or after 1st July 2027, the CGT discount will apply to the difference between the asset's cost base and its value at 1st July 2027, whereas indexation will apply from 1st July 2027 onwards. Let me translate that into plain English with a crypto example. Say you bought Bitcoin in 2024, you're still holding it on 1st July 2027. When you eventually sell, whether that's in 2028, 2030, whenever, your gain gets split into two parts. Part 1, the gain from your purchase date up to 1st July 2027. That portion is still eligible for the 50% CGT discount under the old rules. Part 2, the gain from 1st July 2027 onwards to the date you sell. That portion is taxed under the new indexation system with the 30% minimum tax. To calculate this split, taxpayers may be able to either use a time apportionment method to split gains between the old and new systems or obtain a market valuation at 1st July 2027 to separate gains under each regime. For crypto, this is actually more manageable than for property. Most major cryptocurrencies have publicly quoted prices, so establishing a value on 1st July 2027 should be straightforward using exchange data. For assets acquired on or after 1st July 2027, these assets will be subject to indexation with no CGT discount. Any crypto you buy from that date onwards lives entirely under the new system. Let me show you what this actually means for your tax bill with a straightforward example. Under the current system, you buy $10,000 of Ethereum, it grows to $30,000. You hold for 12 months, your gain is $20,000. After the 50% discount, your taxable gain is $10,000. At the 32% effective rate, that's $3,200 in tax. Under the new system from July 2027, same scenario, but now the 50% discount is gone. Your full $20,000 gain is taxable. Inflation indexation adjusts your cost base upward. Let's say inflation has been 3% per year and you've held for 3 years, so your cost base gets indexed from $10,000 to roughly $10,127. Your taxable gain is now $19,073, and the 30% minimum tax applies, so you pay at least $5,720 in tax. That's compared to $3,200 under the old system, nearly double. Now the indexation does provide some protection in high inflation environments. If inflation is running hot, your cost-based adjustment is larger and your taxable gain is smaller. But for crypto, which has historically grown far faster than inflation, the indexation adjustment will be modest compared to the gain, and the removal of the 50% discount will almost always result in a higher tax bill. Christopher Joy, Chief Investment Officer at Kulaba Capital, noted that the effective CGT rate on productive assets rises from approximately 23.5% to 46-47% once the 50% discount is removed. That's a significant increase for long-term crypto holders. All right. Let's talk about what this actually means for your decisions right now. I want to be careful here because the legislation hasn't passed yet and some details may still change. But based on what's been announced, here's how to think about it. If you're holding crypto with a large unrealized gain and you were planning to sell anyway, the window before 1st July 2027 is the last period where the full 50% CGT discount applies to your entire gain. Selling before that date means the old rules apply in full. That could be a meaningful difference in your tax bill depending on the size of your position. The legislation has not yet passed Parliament, and the final implementation details may still change. There may be amendments, carve-outs, or clarifications that affect how the rules apply to crypto specifically. Making irreversible financial decisions before the law is settled carries its own risks. For crypto you plan to hold beyond July 2027, you'll need to establish the AUD value of your holdings on that date. Start thinking now about how you'll document this. Exchange price records, screenshots, portfolio tracking exports. The cleaner your records at that date, the easier the split calculation will be. One strategy we covered in our previous video was timing large disposals to years where your income is lower, pushing you into a cheaper tax bracket. The minimum 30% tax on capital gains is intended to reduce the benefit of taxpayers deferring gains to years where their marginal tax rates are low. That strategy becomes significantly less effective from July 2027 onwards. With the CGT treatment outside super getting less generous, holding crypto-related assets inside a complying super fund, where the 1/3 discount is preserved, becomes comparatively more attractive. This is a conversation worth having with a financial advisor if you have significant crypto holdings. I want to spend a moment on what we genuinely don't know yet, because there's a lot of detail still to come, and I think it's important to be straight with you about that. No draft legislation has been released to date. The announcement was made on budget night 2 days ago, and the detailed rules are still being worked through. That means some of what I've covered today is based on the budget announcement and supporting materials, not finalized law. Specific things still unclear for crypto investors include exactly how the ATO's apportionment formula will work for volatile assets like crypto, where price movement is uneven over a holding period, how the rules interact with existing loss carry forwards, and whether there will be any specific guidance for DeFi assets, staking rewards, and other crypto-specific scenarios. My strong recommendation: watch this space closely over the next few months as draft legislation is released. I'll be covering every update on this channel as it comes out. Subscribe and turn on notifications if you want to stay across this in real time. Look, this is a big change, one of the biggest shifts in Australian investment tax in a generation, and crypto investors are squarely in the firing line. But here's the thing, you now have over a year before the new system kicks in. That's time to get informed, get organized, and make smart decisions. The investors who will be worst affected are the ones who ignore this and get caught off guard in July 2027. So the action items coming out of this video are clear. Get your crypto transaction records in order. Understand what you're holding and when you acquired it. Think carefully about any large disposals you were planning and whether the timing matters. And speak to a registered tax agent who understands crypto before making any major moves. I'll be doing a follow-up video as soon as draft legislation is released with a full detailed breakdown of the final rules. Make sure you're subscribed so you don't miss it. If this video helped you understand what's happening, please share it. There are a lot of Aussie crypto holders who have no idea this change is coming, and your share could genuinely save someone thousands of dollars. Drop your questions in the comments below. I'll be reading and responding to everyone. See you in the next one.